Hey guys, how's everybody doing? All right, we're going to have some options content. This is for option bros out here. Um, let's look at. All right, I'm on the Tasty Trade email list, like a bunch of us are. But anyway, there's some nuggets on there. I like the Tasty Trade guys, all right. Tom and Tony are great. But there's one guy at Tasty Trade I particularly connect with. His name is Tom Preston, not the Tom that owns it. His name is Tom. Tom, what is his name? Sosnoff. Anyway, this is Tom Preston. Well, Tom Preston is, I believe he's their chief trading officer. I believe he has the same title that Jay just got at Title Financial, chief trading officer, I believe. Anyway, but I've watched a lot of his content. He's on Tasty Trade all the time. He's a VIX and volatility guru, much in the same way Petrocelli is. This Tom Preston has never met an option he didn't like to sell, but he can explain the theory of anything. This guy is very smart. Anyway, so I'm going to take his email. I just got it this morning. Let's look at what he's saying. I haven't put in an option strat. I haven't done it myself yet, but I know I'm feeling shaky about the market right now. And this is one thing you can do when you feel shaky about the market. It's called buy a VIX call spread. In other words, we're investing in volatility. In other words, we're betting on volatility to go up, which is the opposite of the normal trades I show you guys how to do. Normal trades where you're bullish on the market and stuff, you want volatility to stay the same or go down. Anyway, so this is an interesting hedge trade. Let's see what he says. He said, it doesn't take much of a sell-off to spook VIX these days. SPX fell a modest 1.1% yesterday, and that sent the spot VIX up 11%. Remember, you and I were all looking at the VIX yesterday. I was looking at the daily VIX, and we were noticing it's still above the 200-day and moving up. So it's nothing that we haven't noticed. But he said something here. He said, predictably, the front month rallied more than the back month, and that's because there's a panic. The near-term VIX products rally first and faster. In other words, the curve is getting steeper. I should have had this up in advance, but anyway, he's noticing the curve is getting steeper. We ought to start looking at this curve every day too. This can tell you something, but I'd like to try to keep it simple, and I like the little system I show you guys. Anyway, the steeper the curve is, the more bullish it is. The flatter the curve is, the more bearish it is. Anyway, we can watch this every day. See what else he says. The February VIX is trading over the January future by 30 cents, making February really inexpensive, with bond yields moving higher and the likelihood of the Fed rate cut diminishing after strong economic data. SPX might start to test the downside in the coming weeks. I would say that maybe it's going to finally bust through that election gap and follow and do what Russell has already done. But anyway, if that would happen, it would make VIX spike, and I think that's the premise of his trade too. But anyway, this might be enough for a trader to consider a bullish strategy in February VIX options. If you think VIX might keep moving higher over the next few weeks, a long call vertical, that's long the 16 call and short the 19 call in the February expiration, 41 days. It's a bullish strategy. It has a 52% probability, so it's like a coin flip. But it generates, as far as probability, it's like a coin flip, but it generates positive daily theta. You're putting time decay in your favor. Okay, let's go look at this. So it's the 16-19 spread, and all right, well, some broker, I don't know if you can trade VIX everywhere, and some people say never to trade VIX. I'll say this, don't do a calendar spread on VIX. You definitely aren't supposed to buy one month and sell the other month. But this is just but it is all right to buy a spread. A spread is two options. There's buying an option and selling an option, but it's in the same month. When you go between months, the market makers will kill you. That's Jay's even said that on his podcast show. Don't do VIX calendars. Anyway, all right. Let's see. So what he's suggesting is a bull call spread. And it may seem funny that you're rooting for VIX to go up. Okay, and yeah, he wants to do what February 19th. There it is. Okay, so whenever there is a plus symbol, whenever it's a plus one, that means that you're buying to open that option, the 18 strike call. If this was a minus one, you'd be selling to open the 18 strike call. But anyway, so he wanted to buy to open the 19 strike. So this should be positive. Okay, so he wants to buy the 16 call, sell the 19 call. Okay, so the 16 call is bid at $3.10, asked at $3.15. That means you're probably going to have to pay more like $3.15 than like $3.10. Not that you can't split the difference with the market maker sometimes, but on this option, it's bid at $2.07, asked at $2.13. There is plenty of volume and open interest, and there's a really tight spread between the bid and the ask. And those tasty trade guys are good. I've seen worse trades. And so let's talk about the downsides of this trade. What could go wrong with this trade? Well, since you're buying the 16 call and it's lower price, it has higher odds of coming true. So it's going to have has a lower strike price. It's going to have a higher price. So when you buy the 16, if you bought that by itself, it would cost you $3. So you would risk $3. Okay. All we're doing is we're selling the 19 to help finance the 16. We could sell the 19 for around 2. So instead of the 16 costing us 3, we're selling the 19 for 2. The whole deal is going to cost us around 1. All right. So it's, a little bit, it's more affordable. The other thing it does, it's a 59% chance of profit. He was saying 52, but the prices may have moved a little bit. And well, they have moved a little bit because this thing's going up. Max profit's only $188. This isn't that much of a hedge. Anyway, let's save this, and I'm going to share with you guys. This is a very safe way to take a little, bet that the market drops here pretty soon, or at least in the next whenever. Let's see, back to editor. So we'll call this the Tom Preston trade, and we'll call it a VIX YOLO kind of. It's not really a YOLO. Okay, that's just a VIX. That's like a smart way to play VIX. I'm going to show you guys a VIX YOLO. This is more. I'm going to show you guys something. The other day I was looking at what XFAL does. XFAL is an ETF that I like a bunch that has long stock. They replicate the SPY, but at the same time they have a VIX call spread hedge on at all times, and it's really aggressive. They were the only fund that was actually up on August 7th or whenever everything else was just getting murdered because they had a bunch of VIX calls. So I checked what they had on the other day, and I'm going to show you that trade next. But anyway, I will share this trade with you guys. But back to editor. All right, so here's another way to do the same thing. We'll go to the same. I don't like to go out that far, but it could be February before the market drops. Okay, let's just go to the same date and just do a different plan. Okay, wonder if we weren't worried about a little VIX event. Wonder if we were more worried about a big VIX event. Okay, and let's risk the same amount of money even. Let's do that. Hang on, I'm going to make the trades kind of equal. Yeah, this is more of a long shot, and this would be more of a VIX YOLO. Maybe we can bring this in a little bit. Something like this is more what I'd be interested in. Tom Preston, he's a professional market maker. He's my age. He's retired with millions. He knows what he's doing. Take his trade. Don't take my trade. I'm just a guy on, I'm just a guy on the internet. This is more of a risk reward that, that I would like. So let's link the leg. $70 isn't enough money though, to do any kind of hedging. But, something like this. And this would take you out the same date as his. It's risking $480. So I was going to make it equal money, but anyway, something like this would be a decent way to play. If the market keeps going up, you're going to lose this money because the VIX will keep going down, and you'll lose this money. That you only have a 25% chance of profit the way I'm constructing it. It costs a debit to put on delta, theta, gamma, vega. It is theta positive, but not much. Meaning it brings in a tiny bit of time decay. But anyway, this would be a decent way, because what happens is, let's say the market, let's say the market drops before then. Let's say by January 15th, the market drops, and so VIX VIX is like 25 or something at that point in time. This trade would be worth about 1,000. It actually is worth more if it takes longer to drop, because you have more time decay coming out of the option you've sold. Those 30 calls are decaying, and you're making money off that too, and it's offsetting some of the time decay, although not all of it, that you're paying down here in the 22 calls. That's the idea of spreads. You're trying to negate some of the time decay, because you're long an option and you're short an option. The option you're short is earning time decay. The option you're long, you're paying time decay. But between the two of them, you hope to kind of equal it out. Well, anyway, this wouldn't be the worst way to take a shot at lower prices. If we get a VIX, but you need a bigger VIX move with my way. So open them right next to each other. We'll compare the trades to each other. I should have left them the same size. It was confusing it to make it bigger, but I wanted to show that you can get some pretty decent leverage. If you have $400 or $500 to risk, you can get, if you can get a big enough VIX move though. The VIX move we got in August was big enough to make some money on that one. Okay, so hang on here. There's Tom's trade. Here's Max's trade. So I'm going to go back and make them back the same size. That was done. I don't know what I was doing. Two contracts would be $140 enough. Okay, that's close enough for government work. Say by halfway through, a little bit past halfway through, we can see how we'd be doing. And on mine, we'll go to the same date, a little bit past halfway through. Okay, so let's say if we get a VIX of 20, mine would still be underwater. If we go up to VIX of 22, mine would make $141. Tom's, though, at 22 would make $126. Tom's would be capped out after about 26. He's not going to make any more money. Anyway, this one would cost a debit of $112. This one has positive theta also, for what it's worth. This one is more theta positive than the other one, than mine. Mine's riskier. That's why mine has a 25% chance of profit and Tom's has a 59% chance of profit. Tom's hitting for a single because he's looking to make 180 bucks, and risk 100 bucks, 110 or something. So, but I mean, these kinds of trades can work out. It's one way. I just like the way of having a little bit hitting the ball further, because I wonder if we get a VIX at 30 or something. I don't want to be capped out. I'd rather make 740 bucks. We have about the same risk. I'm giving up here at the lower VIX prices. He could make money at 18, 19, 20, and I won't. That's what the give up is. The way his trade does, it starts making it's positive. He's going to make money if the VIX closes anywhere over 18. On this one, I need a VIX of over 20, and that's not even at the expiration. That's by midway through. But I was comparing his and midway through also. I try to always equalize the different variables. So yeah, so this date is February 1st. Okay, even though that's a Saturday, it doesn't matter. Make both dates the same. All right, so February 1st, yeah. So you can see on February 1st, my break even, his break even's 18, my break even is 22. Well, that's the break even at expiration. But anyway, the break even halfway through is important to know too. His break even halfway through is a little bit less than 18. My break even is is 1937. Anyway, but we can also see that you don't even have to go through any of that. Just look at the probability of profit. If you don't want that low of a probability of profit, look what you can do. Just move the strikes closer together. That's one thing you can do. Okay. The other thing you can do is you can move the lower strike closer. See, that goes to 33%. If you go at the money, guess what your chance of profit is? About 50%, because an at the money option has about a 50% chance of being profitable, right? So you could change the trade that way, have an at the money option. Now you've increased your dollar risk. Now you're risking 3 times as much money. But if that's not cool, but you want the higher chances, let's move the legs closer together. Let's go down here to 25. Now you have a 45% chance of profit. You're risking $230, about twice what the other trade is. But you have a 45% chance of profit. He has a 59% chance of profit. I'm trying to show you guys how to do this. I know a lot of you guys already know, but if you don't know how to do this, spreads are the most awesome thing ever, because you can control your risk to the penny. In the old days, like I always say, commissions were so expensive. There's no way you put on a spread. You would lose any edge you had in the spread in the commissions going in and out. With free commissions, that it's the edge, you can still do an edge, and you can do trades like this. So I don't know that this trade right here is not better than my YOLO trade. This way you can make about $1,000 if it hits you can make $900 if it gets in the 30s by February. You risk 230, so it's almost a 4-bagger. I think this is the one we're going to go with. Remember, it's twice as many real dollars as Tom's a professional option trader. He's not even a professional option trader. He's a level above that where he's a market maker. Anyway, there's nothing that guy doesn't know. So probably take his trade. I'm just showing you mine just for illustrative purposes. Okay. All right, guys. Well, I'll share those trades. Hopefully the VIX trade will work out better than the qubits trade. All right. Talk to you Later.